Hi, this is Ed Kime. I'm the CEO over at Quantcha, and in this video, we're going to take a look at our new covered call screener. It's available at Quantcha.com. It's free to use. There's no ads, no registration required. We'll start off by taking a quick tour of the user experience, which is modeled after our option search engine. We start off with the time frame panel at the top, where you can define the time that the options should be expiring, as well as the budget you might have available for the trade and the brokerage, which is optional. And if you provide the brokerage, we will include the trading fees and the brokerage commissions where possible. We also have the ability to sort results that come back from these covered calls, as well as filter out based on stock properties, option properties, and of course a risk and return minimum set of filters. On the right side, you can see we've got a whole set of the top 10 covered calls from, at this point, over 8,400 filtered trades from nearly 127,000 total covered calls. Our system scans the market for the total number of covered calls, filters them down based on the properties that are provided here, and then displays the top 10 covered calls. All you need to do is to change the filters to get a different view on the specific covered calls that are available, and you'll be able to find the trades you're looking for. If we take a look at one of these search results, you can see we've got the company name, the expiration, the symbol, the current ask for the stock, the strike price we're looking at, the current bid for that particular option, and the net debit that it would cost to open a buy right position. Now you can also use this if you happen to own the stock already in order to get the returns on what should be expected for the just selling covered calls against the stock you already own. You can basically just ignore the total numbers here, but the returns are still pretty valid. Now the next step inside one of the results, you'll see we have an annualized return based on a projected range. These projected ranges are based on implied volatility for that expiration. What we're able to do is to take the implied volatility and infer the market pricing distribution, basically where the market expects the underlying stock to go based on how the options are currently being priced throughout that particular expiration. And when you have that information, you can determine a certain level of likelihood. Now these ranges are designed to be about one standard deviation above or below the current position of the stock. So you're looking at about a 68% plus scenario, which is pretty common and usually works out to be, especially in the case of scenarios where the actual volatility turns out to be less than the implied volatility most times, this turns out to be a pretty good indicator of where the stock is going to go. You'll see these annualized returns such as the 91% if the stock is flat. Now that means the stock is flat, but if, for example, it gives out dividends, that those dividends will be returned and factored into the stock itself. So while the stock might be worth less over the period of time, the dividend makes up the difference in what's expected for the return on the investment. The average return is an average linear return, assuming that all the prices within this range are equally possible for happening over this period of time by that expiration date. The potential is the highest amount of return that you can expect to get, and the minimum is saying that if the stock were to hit the worst case scenario, how much of the investment you would lose. Now these tend to be fairly high just because of the fact that we are modeling in the stock taking a significant hit as a possibility. Of course, it's not as bad as if you just own the stock outright, but it is something to keep in mind. Now if we expand the show details, we can get some more insight as to this particular trade. For example, in this case, these options currently have an open interest of over 1,000 and are about 5% out of the money. We also tell you that there's a slightly over 30% likelihood that these options will be exercised before or at expiration. Now, in some cases, that could mean that the stock could be, or the options could be exercised early based on a dividend schedule, where the timing happens to make that early exercise attractive to whoever you sell the options to. But the important thing to keep in mind is if you want to hold on to your stock, to be aware of the likelihood of the exercise of those options that you will be selling. We'll also let you know if there's dividends that are anticipated before expiration and how much, and when the next earning report is based on the expiration. So in this particular case, there's no dividends anticipated, but the next earnings report is scheduled before the options expired, and it's scheduled slightly less than a month before the April date of expiration. The next spot down is our standard trade view, where you can see the specific type of trade, the periodic returns for the trade, the cost and the risk for opening up one instance of this particular trade, and of course the P&L chart that shows you exactly what the results happen for the range that we were talking about earlier. Now if I slide back up real quick, I'm going to change the budget here, and I'm going to say, let's say we've got $5,000 to work with, and the brokerage we're working with is, let's say, Tradier. We apply those changes. We'll be able to come back in and take a look at the trade again. You'll notice the returns are a little bit lower now because it's factoring in the brokerage fees and commissions. You also see that the cost has changed a bit because now we've said we've got up to $5,000 to invest here. So you'll see the investment in a buy right scenario is that we're going out and we're saying we can buy $5,600 worth of stock because we're getting an $870 credit. And so that's one of the abilities here that's kind of nice about the search engine, is that it does the leg math for you as well as factoring in your brokerage fees and commissions that are expected. But let's say you have a different approach and you perhaps want to do something, start to get into some of these filters. By default, the stock filters, there's only a couple filters that are put in place. The first one is the minimum equity ask of $1. The underlying volatility of 15.5%, or 15 to 50% is the range rather. But let's say, for example, we're looking for more near-term trades. So I'm going to select from the time frame. I'm going to move it to the week that starts 2 days from now. And this is another key thing to note, is that you're able to see the expiration week, and of course the date comes at the end of the week. So in the case of right now being January 16th, or rather January 15th, the 17th is this week, the 23rd is next week, but it starts in 2 days technically after the current week ends. But let's say we start with that week that's 2 weeks out, and you can see here we can tell how far out the total amount is. So in this case, if we were to select the let's say these February options here, it's a 5-week total period. That means that it starts on the 23rd of January, so we're starting from a week that begins 2 days out from now, and we want to include 5 total weeks in the analysis. We've got a $5,000 budget, and we're looking to brokerage trade here. Now what we can do is we can also slide down if we wanted to change how it's sorted. We could look at the average annualized return, or the highest potential, and the minimum annualized risk. And these will compare, because they're being annualized, they'll more effectively compare the rate of return for trades that are happening at different expirations. In addition, under the stock filter side, we can put in specific stocks. For example, if we only wanted to look at a certain symbol like Microsoft or Twitter, we'd be able to filter that out here and see the results. The sector, you'd be able to select a particular sector like services, and then from the subsector, say you want business services. In this case, we'll just leave that blank, though we'll go back to all. And they have the ability to say whether or not you want to see include ETFs in the results, show only ETFs, or don't show ETFs at all. We'll leave that as well. For dividends, let's say we want to see stocks that have dividends before expiration, and we want to see at least a 2% yield. And then for earnings, we'll say that we only want to see stocks that have earnings after the expiration. So we want to look for some dividend capture, minimize the risk of the volatility based on earnings, and we could also choose a certain band of market cap size stocks we want to get to, or change the minimum equity ask that's being paid or that's being requested to buy into the stock right now. If, for example, you want to make sure that you're only buying stocks that only trade at, let's say, $3 a share, be able to set that here. And maybe for volatility, you want to open up the gates a little bit and say, you know what, I'm happy to go up to, let's say, 70% for volatility. So 15 to 70% there. When we get to the options side, you can also filter out and say you only want to see trades where you're making at least 25 cents on the bid for the option you're selling, or you want to see options that have high open interest, such as, let's say, 500 here. And of course, we have the ability to show the moneyness, so you can decide if you want calls, for example, that are deep out of the money so that you're less likely to get exercised, or deep in the money because you want more downside protection. And then another option here is our maximum exercise risk, and this basically goes in and analyzes, based on our modeling tools, what the likelihood of the option you're selling is of being exercised before or at expiration. And so in this case, maybe we only want to see trades where it's only 50-50. This is just arbitrary for the sake of demo. And then we could come in and say that we would like to see a potential return of at least 10%. And these are just kind of arbitrary numbers we're putting in just to demo it out here. And you can click any of these apply buttons when you're ready to go through, and we can see we've got the results that have come back. And because of the nature of what we're looking at here, there's some risk involved. But you can see something like Blackstone Group here has a lot of volatility recently, and therefore the trades are pretty good for something that's expiring in the next week, to be able to go in and say make some good money on this. But let's say we also wanted to drill in and maybe pick something that's slightly less volatile. So we'll come down here, and oh, actually the volatility is about the same. Let's say we pick Carnival, and we see the trade here, and we're interested. The next step we can go to is actually to drill in and get a really deep analysis as to that particular trade. The first thing you can do here is, this is part of our trade analysis, is to come in and check out the distribution of the price expectation based on the market distribution. In this case, we're looking at a range of about 67% based on what was modeled in the previous step. We can see the exact steps that we've got to open up the position and the estimated commissions and fees. We can come down into the analysis to see, for our particular trade forecast, which is this 41 and change to 48, what the linear return is, the highest potential return, and what range that exists in, as well as the probability of this range being accurate, and the probability of profit if it does close in the range we're looking at. The next panel is the full implied range, which goes out all the way to 3 standard deviations and tells us at almost 100% likelihood what the expectation of the market is right now for this stock and how it should end up. And so you can see that it looks like the market expects a trade like this to be profitable at nearly 60% likelihood. If we scroll down a little further, we can see some of the volatility information. This is just useful to see kind of where the volatility is, as opposed to the current the calls versus puts, as well as the current stock, and where our forecast lies within the implied distribution. Coming down a little further, we can take a look at some of the Greeks, and the main one I guess you'd probably care about here as a covered call investor is theta, which says that for this particular trade, based on the current market circumstances, if we were just 1 day closer to expiration and all the other factors are the same, like the price of the options and the price of the stock and the volatility and the risk-free interest rate, that you would burn off about $1.61 in value if we were 1 day closer to expiration, which is not great. But also keep in mind that that's something that accelerates over time. So this will increase significantly as we get closer to the expiration date, which is out in February. And keep in mind also, it's the $1.61 that's being burned off here is really coming from the $95 of option credit we're getting. Don't think about the overall cost of the trade here. It's just that change of that 95. And then of course, if we were to stay where the pricing is, if it were to be flat, you'd end up with full profit on that option and keep the stock as well. But another good example here is Delta, which says that if the stock were to go up, in this case to $61, it would be, if it went up $1 more, this whole trade would be worth $61.49 more, all other factors being the same. And so that's a quick look at the information there. If you wanted to dive into the option chain, you'd be able to come in and see details about where the calls and the puts are right now, the implied volatility, the estimated value of what the option should be based on our pricing technique, the assignment risks, and some of the other Greek information in a raw form. Another key thing is, based on what we're looking at, we can come back to search results if you wanted to broaden your scope here and say, well, maybe what I really want to do is I want to see collars, because I like the idea of doing these covered calls, but I'd like a protective put on the downside. And because maybe I'm a little bit bearish on the stock, so I'm going to say maybe we're looking at like 40 to 46 is the range. And if we apply that, we can see that there are some trades available, and we might want to get into, for example, this one that returns about 0.5% pretty consistently within that forecast you were looking at, and be able to get a full better opportunity at profit. In fact, based on the way the market's currently aligned, we're looking at pretty good profit probability for that particular trade. But the point is, the tools are here to support what you want to do as a covered call investor, and that's the work that we're putting in here, and we'll continue to invest. So your feedback is welcome. Please contact us at hello@quantcha.com, and happy trading.